Hi, everybody. Welcome to a special video version of the Wiser Financial Advisor podcast. Got myself and Jeremy Busch here today, certified financial planners and experts at all things financial. Welcome, Jeremy.
Thanks, Josh. Glad to be here.
Yeah, CFP, that stands for, that's kind of the gold standard when it comes to the financial industry. And both of us are CFPs, and we've got other letters after our name too. But yeah, those are definitely the ones that you want to look for when it comes to vetting financial advisors or planners. Today, we thought that it would be interesting to do a portfolio sanity check with all the turbulence, all the craziness of the last couple of years. It would be a good time to just give you our thinking a little bit. And also, I think some of what we talk about is going to make you question a little bit. Maybe it's reaffirm what you're already doing, but it also could result in some changes in how you'll manage your portfolio.
Absolutely. So it's really just designed, how do I know my investment portfolio matches my expectations?
Yep.
What expectations should I have given a certain risk number?
Yeah, absolutely. And a lot of this, and for those of you who are seeing the video version of this, volatility is volatility. It's turbulence. What we're not talking about is we're not talking about permanent loss of capital because you put all your money into one stock or all into cryptocurrency or something like that. What we're talking about today is diversified portfolios. So even the aggressive versions of it, in other words, we're talking about diversified portfolios. But on the slide, you can see that there's a straight line up version of a very, very mild salsa portfolio. That would be one where you get the same thing every single year. And wouldn't that be nice, if it was exactly predictable, like the same thing, and it was really high return, right? That would be the ideal investment, high return, no risk. The reality is almost every investment portfolio is going to involve some volatility. And so every person has to kind of come to grips with that as far as risk equaling volatility and how much they can tolerate on their own.
Exactly. And when we talk about risk and volatility, it's really just the higher the risk, the sharper the volatility.
Yeah.
Right. Sharper up, sharper down. So it works both directions on that.
It does. It does. And the reality is, we'll talk about this in a bit, is that sometimes turbulence is required. Accepting that is required depending on where you're trying to go. If you're trying to go to Hawaii, you're probably getting on an airplane or a ship, but either way, there's going to be volatility, right? It doesn't matter how big of a ship or how big of an airplane or how good the pilot is, that you're going to end up with some volatility along the way. But if you want to get to Hawaii, that's how you're going to get there, right? Or you can choose not to go, and that's really what we're talking about today. There's also something, the concept of the efficient frontier, and in our world, that's the jargon basically for kind of looking at different flavors of portfolios. From really mild to really hot, and basically the theory behind it, and I would say it's more than a theory, is that the more risk that you take, the more potential return that you can get.
Absolutely. And really the whole idea behind an efficient portfolio or an efficient frontier is that there are ways to kind of maximize between asset classes, right? So if we have two basic asset classes of stocks and bonds, finding what combination of those is the most efficient for you, right? And so oddly enough, I think a lot of people don't realize, and if you can see the slide, 100% bond portfolio is actually more risky than a 20% stock, 80% bond portfolio.
Yeah.
And the reason for that is primarily diversification.
Absolutely. Yeah. So advantage, I always say that again, example of really inefficient portfolio would be one where there's a lot of risk and no return. Of course, that would be really inefficient. There'd be no reason to do that, right? So basically, the average investor is going to be looking at, okay, if I can step up the risk, that means that I should have really high odds of getting a better return for this. Otherwise, there's no point. So lots of volatility to go, 5 miles down the road. That's not really worth it. And so I think people are going to be looking at that. They want the payoff, in other words.
Absolutely. And you can have an inefficient portfolio by all means. And a lot of them are out there, right? We see them all the time.
Yeah.
People who have a lot of something in one specific stock, maybe their company stock.
Yeah.
Not super efficient.
No.
And it adds to a lot of risk.
Yeah, for sure. Yeah. And sometimes company stocks can do well for a period and then they really don't. We've got lots of examples of that, of people that worked an entire career at a company and then at the end, the company kind of went away. Lots of examples of that, of brands that don't exist anymore. So that brings us to what we're really interested in talking with you about today. Is there's a study that Jeremy and I saw in Financial Advisor magazine earlier this year, And we read through that study, and some of it wasn't earth shattering. It was like, yeah, we've seen that before, but the results of the study really were kind of striking as far as the end result. So let's unpack that a little bit.
Absolutely. Yeah, so really the basis of this study is that they took really the last 50 years worth of actual portfolio performance. So starting December 31, 2022 and going all the way back 50 years. Okay. And then they kind of averaged out those 50 years to give us a 25-year living and retirement time frame.
Right.
Okay.
So, looking at lots of different periods of inflation and deflation and financial crises and the dot-com crash. So 50 years is enough that it kind of washes a lot of that
data.
out.
Yeah, a lot
some
of
good
crazy
averages.
stuff.
Yeah.
Yeah. And so really how it started out is it looks at really, your basic, is this 5 or 6? It looks like 6 actually. So 6 portfolios. Everybody starts out with $1 million portfolio.
Yeah. 6
Okay.
investors.
And then it looks like 25 years over the next 25 years, taking out distributions, where you end up and what happens along the way.
So kind of look at it this way: the average, normal retirement, in other words, would be somebody retires about age 65. So that gets you out to about age 90 then, right?
Absolutely.
Yeah. So, and hopefully,
Very doable.
we all live that long and live really healthy up until that point. But yeah, that's a long period of time though. Certainly it's a lot of
Yeah.
income and a lot of stuff that's going to happen in between.
Absolutely. Yeah. So really then it comes down to, okay, what type of portfolio do I have? How does it fit in? What are the expectations on this? So if we let's say start out at the top.
Yeah.
So an aggressive portfolio, really this is and now mind you, these are all very diversified portfolios in their own right. It just depends on how much volatility you're willing to run with.
Yeah, so you gain international diversification. It's all stocks, but you're going to be getting kind of the stock market around the world, a little bit of everything.
Yep. So a really aggressive portfolio, you start out with $1 million going into retirement. And then it says, all right, our distribution rate should be around the required minimum distribution rate for this. So we're talking right around that 4% that we usually talk about, right? And so as we look through it, there's a couple key things that we'll look at through these. So total amount you would have withdrawn in the aggressive portfolio. So we're talking about 80 miles down the road, interstate speed, as far as your risk score. You would have taken out about $5 million in distributions.
Yeah.
That averaged out to about $200,000 per year. All right. And then not only do you take out $5 million, but at the end of the 25 years, you're actually left with $3 million.
Yeah, that's incredible. I mean, you
That
think about that you only started with $1 million, but you got $5 million worth of spending. I mean, $200,000 a year, that's a lot of trips and gifts and all kinds of stuff that would have produced.
That's a pretty nice lifestyle right there.
It is. So that's a lot of money. That engine that we started with, in other words, that produced a lot of results.
Absolutely.
Yeah.
Yep. So at that distribution rate, at that growth rate that's associated with that aggressive portfolio, that's kind of what you would have seen literally over the last 25 years.
Yeah, but a 75, 80 mile an hour portfolio, some people are comfortable with that in retirement, but some people aren't, right? They just know themselves well enough that they know that the volatility that kind of comes with that during the down years isn't worth it to them. They'll end up losing sleep at night, or the worst, of course, is that people end up not understanding their risk and they end up bailing out right at the bottom of the market. Just because they say, I can't take anymore, and they end up cashing out right at the worst moment. So, so as we go into the more conservative portfolios, that means that we're going from the hot salsa, right? The most, spice that's in this thing, that's going to be the most volatility, the most turbulence that we would have. So as we start adding other ones in here, second one is the 80-20 portfolio. That would be a risk score of about what in our world?
Yeah, 80-20 in our world would be about let's call it a 67 or so.
Okay.
Yep.
Good. And where do we end up there as far as spending and outcomes?
So with that one gives you overall spending over those 25 years is about 4.5 million, 4.4.
Yeah.
Average annual withdrawal on that one, according to the distribution rate, is 176,000.
Okay.
So Yeah, you're still looking pretty good, about 25,000 less per year,
Still pretty good, but I mean, it is a
right?
difference, right? That's a couple $1,000s less per month
Absolutely.
spending. Could think of a
Yeah,
lot of stuff you could do with that, right? If you had that money.
absolutely.
Yeah,
And some people might be thinking of this and say $176,000 a month. It's more than I have
a
now,
year. Yeah,
right? Or
yeah, a
yeah,
year. But
in
yeah,
a year, yeah.
176 a month be awesome.
That'd be really now
Yeah.
176 a year, that's nothing to sneeze at,
Mhm,
right? But you still end up, so over that 25 years, you spend 4.4 million,
mhm.
you still end up with $2.5 million left over to give to the kids.
Yeah.
Yeah,
So again, not too shabby, but it is a couple $1,000s less per month of spending, and effectively about $1 million worth of money that somebody's not going to get, right?
absolutely.
Yeah. So there was a price, in other words, to go to a more comfortable portfolio. And the real question is, are you willing to pay that price or not? One way or the other,
Yeah.
right? Kind of dialing up or down these different portfolios. Then we go to a 60-40 portfolio, which is kind of a stereotypical balanced portfolio
Mhm.
in lots of studies, things you'll read, they say, oh, 60-40, that's kind of an average. Maybe a retiree has their money invested like this. So where do we end up again from spending and outcome in the end?
Yeah, so 60-40. Now you're looking at maybe a 57-58 on the risk score,
Mhm,
really middle of the road. Average annual withdrawals 150,000,
mhm,
so nothing to sneeze at. You'd have spent about $3.7 million over your 25 years of retirement,
mhm.
and you still end up just north of $2 million.
Yeah.
Not too bad,
Not too bad,
but you can start to see that
but there is a
trade-off there,
difference. There
right?
is.
Yeah.
Yeah, absolutely. Yeah, but we have a risk assessment that we have our clients take, and they can
Mhm.
retake it as often as they want to, because it starts to kind of show some of these trade-offs as well. But I think when you see it over a 25-year period, it really is striking as far as
Mhm.
kind of end results. And I think it could result in some different decisions for people, maybe even that are already invested with us. They might look at this and say, I need to look at that again. I need to make
Mhm.
sure I'm in the right spot. All right, then we flip it to the kind of the opposite of the balanced portfolio, 40-60, 40% stocks, 60% bonds.
Absolutely. So yeah, that 40-60 now. So now we're definitely getting more in the range of the conservative
Mhm,
type
yeah.
investor, right? So 40-60, now you're looking at, average annual withdrawals, again, about 130,000 per year.
Mhm,
So, and then really spending right about that 3.2 million over that 25 years. And you end up with about 1.6 million
yeah.
when it comes down to it. And that's on a portfolio that's probably around that 50-mile-an-hour range,
Yeah.
if we're thinking of our typical risk
Yeah,
scores.
absolutely. And you kind of look at the end result there. That is about, and this is zero judgment, by the way, but you are talking about we're getting into the millions of dollars difference, right?
Mhm.
As far as how much you were able to spend and how much you got to leave your kids or grandkids or whoever's going to get your money, or a charity. Even
Absolutely.
maybe you're leaving it to the church or a charity or somebody else, but that money's just not there, right?
Absolutely.
Yeah. So
Yeah.
we just need to recognize the difference. And then, of course, going to a super conservative portfolio, yeah, the 2080, we've got 100% fixed income portfolios. We didn't run out of money. So again, the good
Yeah.
news is we didn't run out of money. So that usually is the number one fear of retirees. So we want to be careful about that.
Absolutely. So really, when we look at these, like you said, we didn't run out of money in any of these situations. Couple key things to point out on these, though, is
Mhm.
that one, we were using a very usable distribution rate,
Right.
right?
Yeah,
So if you are a current client, you have heard us talk about the 4% rule
that's right. Very
by all
important.
means.
Yeah.
All right. So that is a major assumption in this study,
Mhm.
is that 4% rule was basically lived by. Okay. So it shows that that is very possible. The other thing is really to consider, then it just becomes a matter of lifestyle preference,
Yep.
right?
It's true.
So how much are you willing to stomach as far as volatility goes? How much of a
Mhm.
lifestyle do you really want?
Right.
Right? Because if we look at the very top and we look at the very bottom, you're talking about $100,000 a year difference
It's huge.
that is available to you.
Very different type of retirement.
Hmm.
I think both, all of these, I think most people could live on, right?
Absolutely.
But you're probably not going to Europe and Australia and that a lot anyway. If you're in the
Yeah.
super conservative portfolio, it's just not going to produce the income to make
Yeah.
that happen. It might be like a once in a lifetime I went to Australia, but if you want to do stuff like that continually and have that kind of a
Mhm.
lifestyle, big difference. So again, it all involves trade-offs.
And that's the thing too, is that some people might look at that and they say, well, I do not need $200,000 a year.
Right.
Right. And so why would I subject myself to that? So that's the other kind of thing that figures into risk, right? It's how do you want to live? What is your lifestyle? What do you want retirement to look like? And that can help us feed into, okay, well, how much risk do you need to take versus how much risk are you comfortable with?
Right.
And sometimes those don't match up, sometimes they do.
Yeah.
But that's why we have jobs, is to help people do that.
Yeah, absolutely. And so that's where the art and the science comes into this, right?
Yeah.
And sometimes, we put on our psychology cap and that sort of thing, because a lot of it does come down to psychology.
Yeah.
And the thing that blows all of this up, by the way, one of those is the distribution rate as far as how much you're pulling out. But the other thing that blows all of this up is that if you bail out when times are tough in any of these portfolios, it completely blows up these numbers, because these rates of return that we're seeing here were the actual rates of return that an investor would have gotten over that period of time. That's true, but that's for the person who didn't try to time the market.
Exactly.
They didn't get scared and sell when things went down. They also didn't get greedy and do stupid things when the market was really high, right, and going up. So market timing does not work consistently. We've never seen a study that has shown that can be done. Even the most successful investors, think Warren Buffett and others, have said they've never met anybody who can consistently time the market.
Absolutely.
So I think that's really, really important to recognize, is that emotional component of making sure that you're in the right portfolio is so key. So you can hang in there when times are tough. You can hang in there when you have a bad year, like last year. Pretty much all of these portfolios would have been down last year. It really wouldn't have mattered. In other words,
Absolutely.
what flavor of salsa from the mild to the hot, it wouldn't have mattered, because everything was down. Stocks, bonds, real estate, everything had negative numbers.
Yep, absolutely. And that is a really good point, is to stay invested, know that you have a long-term plan. And I think the really interesting thing about this, and we've talked about it, is that you're looking at a 25-year retirement right now. I think the hardest part for people to look at is beyond that short term,
right?
Especially when you're living in a market year like a 2022, that's the only thing on your mind at that point,
right?
For I think most people, it takes savvy investor to sit back and look at a negative return in 2022 and say, I know I got a long-term plan. I'm all right. We're going to make it through.
Right.
That's what we had to help quite a few people through, I think, on that during 2022. But to be able to look at it on a 25-year level and say, how many people do that? You look, 5 years out, or say, what are we going to do over the next 5 years? Obviously, as CFPs, we're planning 30, 40, 50 years in advance for a lot of people, right?
Yeah.
And so we're in the habit of this, but when you put these numbers behind it to say, okay, this is how much you could have spent or you would have spent
right
at this rate and how much you would have ended up with, pretty eye-opening numbers.
It is, yeah. So you're really trying to gauge two different things. Kind of the science behind things would be, again, an end result. I think a big mistake that people could take from this is to think, well, the best result would have been that hot salsa, that 100% equity portfolio. Well, duh, why shouldn't I put all my money there? Well, for some people, that's appropriate. That might be appropriate, and you'll sleep like a baby at night. That's great. But the big mistake, I think, is not recognizing the emotional component, what you really can tolerate. Because when you're in a terrible year, and we've had them, right? Financial crisis, early 2000s, where the market, that portfolio, in other words, that 100% equity portfolio would have been down by over half. That means your $1 million would have been worth 500,000 for a while. And when you put it in terms of that, some people say, no, I couldn't live with that. And somewhere along the way, I would have called Josh or Jeremy up and said, all right, get me out. Then again, that negates the entire thing here. That means that you wouldn't have come back in a year like this, where the market's actually done very well. How sad. I'm sure for people last year, none of our clients did this, of course, but how sad for people that would have bailed out when the market was down 20, 30% last year. And then they never got to come back. They didn't come back to fight another day when the market has done so well coming up this year.
Absolutely. They would have missed out on 6 of the best months to start a year pretty much ever.
Right. Yeah. So yeah, again, there's some art and some science to this. So again, I want to reiterate that as well, is just making sure that people don't think, oh, you guys are saying I should take a lot of risk. I need to go to the most aggressive portfolio. Again, for some of you, maybe you do, maybe you're perfectly comfortable with that. It's not an age thing, by the way. I know some people will probably argue with me on that, but we've got clients that are quite old actually, and have a very high risk tolerance. And
Absolutely.
the market volatility does not bother them a bit. And they don't even think about who the president is with regard to their portfolio or what's going on in the world. So for those people, it's fine.
And we have clients who are very young, who
Yeah.
are just the opposite.
Yeah,
Do
exactly.
not want to take that much risk. They can't stomach it. And that's fine. They have a long time frame to use, and they don't have to take that much risk in order to get where they're going.
Right. Yeah. So kind of hammering home what we're talking about today is making sure that you've thought through this. And certainly, even though we have a risk tool and a risk assessment and a conversation when people come on board as clients, we have lots of conversations, but that doesn't mean that it's just a one-time conversation. It's something to reassess over time. And really, sometimes you see some things in a different way, and it does kind of tell things differently as far as how you might want to have your money invested. All things equal, though, you want to make sure that you're not taking too much risk or you'll bail out when the market goes down. But you also want to make sure that you're not taking too little risk, because you might have just on a whim say, oh, I'm a 40-mile-an-hour person or 50-mile-an-hour person. But then over a 30, 40-year time frame, you look at the differences. In other words, we don't want to just be kind of flip about that decision. We want to really understand what that means and what the outcomes end up being. So hopefully that was helpful, though. That was really the goal today, is kind of unpack that a little bit, give you our thoughts. It's a really good time to be talking about this because times are good right now, right? The stock market's come back, bond market's come back, real estate, kind of settling in, depends on what part of the market. So this is a good time to talk about it, because if you're kind of thinking, you know what, I'm taking too much risk, maybe it's time to dial it back a little bit. And good for you, right? The fact that you've kind of gotten to recover some of those losses from last year. But the opposite is also true, though, is really thinking through the two of those. Making the complex simple, you can see the slide we've got up. Some of you have seen this in our offices before. This covers the myriad, all the boxes, basically all the different areas of the financial world. This is Jeremy and myself. We say this is our job security slide, because the reality is there's so much complexity in the financial world. So much of the information that's out there contradicts itself. And of course, it changes all the time.
Always changing.
Yeah. The tax code, the laws, the market, the economy, the president, all the different things that are out there changes constantly.
Plus your personal situation.
Yeah, exactly.
Changing. So something that's relevant tomorrow or today may not be relevant tomorrow.
Yeah, right? Absolutely. So, yeah, that's why we're here. We're here to be a caring advisor, somebody that you trust, that has a lot of experience, that has a lot of book knowledge as well. So we want to make sure that both of those are dialed in, that we've got the competence and the years to under our belts, that we've seen a lot of things that work and we've seen a lot of things that don't work for people. And so, of course, we can't guarantee anything, which will be in our disclosure slides later. But the reality is this is about your life, your situation, and the world is not getting any less chaotic. It's not getting any less complex. So it's about navigating those waters, regardless of what those might be. We've got a great team, so we are here to serve you. We do thank you for those of you who are our clients. As always, thank you so much for trusting us. For sending your friends and family, coworkers as well. That's nearly 100% of how we grow, is just by people sending their friends to us when they need help. So thanks for getting the word out there on that and letting them use us as a resource, because they probably need our help. They need somebody's help. So it might be us, it might be somebody else, but make sure they get competent advice from somebody who cares. There is our disclosure slide, written by attorneys that care very much about all of us. So biggest thing is these are our opinions today, and that we can't guarantee anything, but it is based off of our experience and what we see, right? When we have stuff like this come up, we want to make sure that we're passing it on to you and helping you make great decisions.
Absolutely.
And our contact information on here as well. Best way to contact us, just keep it simple. Just Josh@KeystoneFinancial.com, Jeremy@KeystoneFinancial.com. Our website, as you can imagine, is KeystoneFinancial.com. Our social media channels are out there as well. For those of you who are on the podcast, make sure you hit subscribe, share it to your friends. We always appreciate reviews, ideally 5 stars, but whatever you think we deserve for the content that you're seeing today. Thanks for your help. Thanks for the trust that you put in us, and have a great week. God bless.
Take care.